The Hot Seat.
Welcome to the Hot Seat, a debate segment where ideas clash and insights spark. I'm your host, Hongbin Jeong. Investment-linked insurance plans, or ILPs, are booming in Singapore. On the surface, they promise the best of both worlds, insurance coverage and investment growth in a single product. But there's a catch. Complaints have skyrocketed from 55 in 2023 to 211 in 2024, mostly around misselling, poor disclosure, and advisors pushing products that don't fit clients' needs. These plans can be confusing. Some focus on investments with minimal insurance, while others are protection-heavy but offer little growth. For many consumers, the risks and returns aren't clear until it's too late. That's why regulators are stepping in, considering classifying ILPs as complex products and introducing safeguards for selected clients. So the questions we're tackling today are ILPs really suitable for most Singaporeans? Should we really add ILPs into our investment portfolios? And are advisors doing enough to help people make informed choices or just making a sale? So can we really grow our money through ILPs? Before we hear from our guests and dive deeper into this debate, here's a disclaimer. The interviews or the views and arguments presented by our interviewees do not necessarily reflect their personal beliefs or opinions. Instead, they're here to provide a fresh perspective on the topic at hand. On that note, if you'd like to send some questions in for our guests, feel free to WhatsApp us at 88550893 or leave a comment on our Facebook, LinkedIn, and YouTube, as we're currently streaming live on those platforms as well. Without further ado, joining us today is Farhan Samsudin, who is the Deputy Director of Financial Advisory at Synergy Financial Advisors, who will argue that ILPs can help us grow our money. And on the other hand, we have Eddy, CEO at Haven, who will argue that ILPs are too risky and may not be a reliable way to build our wealth. Hi, both. Thank you so much for joining me today.
Hi, thank you for inviting.
Thanks for having us.
All right. I want to start off by asking the both of you, how much returns can you actually get by investing in ILPs? Farhan, you want to go for that first?
Well, first and foremost, it depends. Because it depends on the risk appetite of the client. And that will influence what kind of funds that we recommend for them, right? So, of course, if you are a low risk person, then we are recommending low risk funds, and the returns would hopefully be between 2 to 4%. And of course, if you're high risk, it can go as high to 10, maybe even more. But of course, high risk funds means high volatility, and whether you can handle those volatility.
Okay. Eddy, what are your thoughts?
There's no fixed return when it comes to ILP. So unlike the traditional whole life and savings plan, whereby the returns are more or less predictable, for ILPs there's no fix, there's no guarantee. So it all depends on the underlying sub funds that you select as a policyholders. So as a gauge, if you are selecting bond funds, bond portfolios, the range of returns could gross between 2 to 4%. But if you are going for equity portfolios, it could range 6-8% or so and so forth. And depends on where it goes in and how diversified or concentrated it is. But it's not just about the returns. For ILPs, there are also costs involved, the charges, the distribution costs, the fund fees, which could add up to about 2% per year. So all in, that will be the actual returns will be net of fees. And as what Farhan said, there is no guarantee. If the market were to underperform, you may suffer losses.
Okay.
Definitely.
Well, now, while ILP sales in Singapore have continued to rise, it looks like complaints to the Financial Industry Disputes Resolution Center also jumped sharply from 55 in 2023 to 211 in 2024. So, Farhan, if ILPs were so effective at building wealth here, why do regulators and financial literacy advocates often suggest separating insurance from investments?
Well, I would say that's probably an assumption. I mean, even in the financial industry, we have differing views on whether one should buy term and invest the rest, whether there are different products. I personally feel that every financial product is created for a reason, for a purpose, and it should be recommended in accordance to the client's needs and objectives. So ILP is one such product. If recommended in accordance to client's needs and objectives, it works. However, we do see, and I personally receive complaints from clients or friends whereby they were missold that ILP. They didn't know the different terms, the locked in, or probably being asked to commit for 30 years. So the problem lies not in the products, but in the advisor or the agent.
Okay, we'll circle back to that in just
Sure.
a bit. But conversely, Eddie, if ILPs are so inefficient, right? Why do insurers, keep them alive? And why do so many people still buy them? Is it all misselling or is there real demand?
Maybe I start with why is ILP inefficient or ineffective. All right, because ILP, as we know, is a combination of two products, two needs, a protection need and investment needs. And these are actually opposing objectives. When you think about protection, you're thinking of something that is safe, a product that is safe and that is reliable, that in the event of a claim is there. When you think about investment, it's about returns, about risk. It's about taking more risk to get more returns. So when you put these two products together, you're mixing it up.
Mixing two objectives.
It's like jack of all trade, master of none. You don't get the best of both sides.
Right.
So it is better to split it up. If you are looking for term protection, a low-cost term, it will do a good job. Investments, there are lots of investment options to consider. Don't have to be bound by the ILP's restrictions. So then what about why are people still buying ILPs? I think it's fair to say that most people want to grow their money. Most people want to get rich for retirement, to have more. Okay. And the narrative of ILP is that, well, you can have best of both, protection and investments. Insurance is a boring subject. But when you add investment in, it becomes something interesting. So it could be the narratives that people are drawn to, not because of the product, but the idea of getting returns, and that sparks the growth of ILPs.
Okay, makes sense. Well, one thing about ILPs is that the sales charge are typically high. They typically have a high upfront and recurring fees. Correct me if I'm wrong, right? Say the S&P 500 ETF returns 8% annually. After a 0.1% ETF fee, you might net about 7.9%. A similar ILP-linked fund may net only 3 to 5% after policy and fund charges. So, Farhan, if the goal is wealth growth here, why wouldn't someone just invest directly in a mutual fund or an ETF, which often have lower fees and greater transparency? How can you prove ILPs, offer superior value compared to those alternatives?
I would argue that ILP doesn't provide superior value.
Okay.
It provides value, but not necessarily superior to unit trusts or ETFs. But why would an advisor like myself recommend ILP? It's because, one, we see that clients need that discipline. So they're looking at ILP as a form of disciplined savings with the investment component. And two, there's a component of legacy which probably many advisors do not touch on. That component of legacy, ILP being an insurance product, you can do a nomination. And that is probably what clients should consider looking into. Now, should ILP be used for protection? Arguably, no. I disagree. I would recommend that ILPs should have minimal protection as possible. Unless you're using a protection ILP as a mirror to whole life policy. But that is another discussion of its own.
Okay. Well, on the flip side, ILPs combine insurance protection and investments in one plan, which some people like for convenience, right? So, Eddie, are you dismissing the convenience and potential peace of mind that investors get from, bundling both into a single product?
Well, I get it that people like convenience, like to get two in one instead of getting two different pieces. That's true. But the question to ask is that what are you sacrificing when you are having a two in one? Okay, because when you're having a two in one, you're having a trade-off.
Correct.
And the trade-off is that, firstly, we talk about the cost. The cost of ILP is not low because you're paying for the fund fees, you're paying for the distribution cost, you're paying for the product itself. So it is costly. So this cost drag, what it means is that it will eat into your returns. And second is about limitations of funds within ILPs. ILPs do have a range of funds, but when compared to the universe of funds out there, the kind of diversity, there's a lot to choose. Why do you need to be restricted by the in-house ILP funds? And thirdly, protection. If you are using ILP as a protection, then there's a risk of the policy lapsing if the funds didn't perform well and there's not enough units to pay for the insurance charges.
Okay. Well, if all of this is about convenience here as well, Farhan, aren't, robo-advisors more convenient? Why should anyone pick an ILP, which has higher fees and lock-in periods, over a robo-advisor that arguably provides safer, more efficient, and more liquid access to markets?
I'll be frank, I'm on robo-advisor myself. Okay. Well, because sometimes you have to test it out to see how it works, right? One thing I realized about robo-advisors is, yes, it provides convenience, low cost, but I'm still restricted by the funds that they offer, or most of the time, as a retail consumer, I don't even know what funds I should get into. So I would rely on the portfolio that the robo-advisors offer. The same goes for ILPs, even the same goes for unit trusts. There are thousands of funds. Which one do you choose? So either you trust the advisor's recommendation or get the advisor, hey, do you have any pre-made or pre-tailored portfolios?
Right.
And what are their performance? How is it being managed? So these are the questions that I feel customers or clients should ask. Yes, you like the convenience, but what's the trade-off? What are you willing to put yourself into? What are you willing to commit? And what exactly do you want out of what you're signing up for?
Definitely. I mean, not everyone has that financial literacy to manage and invest their money, right? So, Eddy, if ILPs provide professional fund management and convenience, is it realistic to expect all retail investors to, DIY their portfolios?
That's a tricky one.
I don't think everybody is able or suitable to DIY investing because that requires a lot of experience, expertise, and time and effort. All right. So no, not everybody can do that efficiently. But for those who can do it, the same professional fund management expertise access can be accessed through various means. It can be accessed through ILPs, yes. It can be accessed through unit trust, ETFs. So there are a lot of platforms to access. Don't have to be ILPs. Okay, so why does, and for people who actually need help, for people who are very investment savvy, they can train their own. They can open an account, brokerage account, and invest on their own. That's the lowest cost. You get best
Yes.
return. But for those who need help, they can seek an advisor. But I'll say that advisors need to be investment savvy to understand the various platforms out there.
Indeed.
Because there are ILPs, there are investment platforms that offers lower returns. The same savings plan can be activated in online platforms. It can be done.
Right.
So why do we have to be restricted to ILPs? There should be a consideration between a broad range and then to select what is best for the clients.
I think we've got some great perspective from both of you. I want to bring up a case. Now, this is the case of a 63-year-old stallholder with limited education who was sold a high-risk ILP when he was only seeking stable retirement income. Now, his financial advisor apparently misinterpreted the policy's risks and suitability, and FIDREC later awarded him with a partial refund. So, Farhan, many ILPs are sold by advisors who only need a basic license and earn large commissions. I mean, compared to wealth managers or traders who actually go through years and rigorous, education through about markets and all of this. But then why should ordinary consumers trust these advisors' investment judgments on complex ILPs, especially when mistakes like the case I've mentioned above happen?
Well, it is upon the individual advisors or agents to ensure they are constantly updating, upgrading themselves. And there are basic trainings that we go through, such as to ensure if client is above 60, then they are selected clients. So you need to exercise extra precaution. You need to advise clearly what are their means, what are their affordability, what are their competence in understanding the products. If you're talking about 60s and above, these are the type of clients that we do not want to expose to any risk at all, if possible. So it is, I would say, it's a mistake of the advisor. It is a mistake of his manager for not guiding him properly.
Okay. Well, then, Eddie, going back to the same case, isn't this just a case of poor advising, as Farhan has just mentioned as well, then a flaw in ILPs themselves? If sold correctly, shouldn't it mean that ILPs can still help investors grow their money safely?
Right. Firstly, I feel sorry for these 63 store owners. Obviously, he's not. It seems that he's not savvy about investments. He don't just lose money; he loses his opportunity cost. He could have put his money in the CPF and earn 4% risk-free returns for his stable retirement income. So there are ways he should have done for him. But back to the questions, I think I just want to use a cooking analogy to
Okay.
explain this thing. If you have a poor quality ingredient but you have a very good chef, the outcome, the dish will not be outstanding because the ingredient is not good. On the other hand, if you have a very good product but the chef is mediocre, the dish will not turn out well. So in order to cook a very wonderful dish, you need to have a very good ingredient and a very good chef. So I guess you know what I'm trying to say. The product has to be excellent, and the chef, the advisors need to be very good when it comes to investing, guiding the clients to understand how to navigate and getting the returns that the person is aiming for. At this moment, ILPs have its flaws. I do see that there are more advantages going into splitting costs, splitting protection and investment separately to get a better returns outcome for consumers. But I hope that one day the ILPs can improve so that it can become viable products. And also hope that the advisors will also upskill themselves so that they can actually truly benefit the consumer at large.
Okay, I think we've got some great insights from both of you, and I want to end off this debate by asking the both of you. I'm sure a lot of listeners are curious as well. Who actually benefits more from ILPs in the long run? Is it the investor or the insurance agent? Farhan, you want to go off first?
Well, it depends, right? There's an element of fate. If you somehow meet the wrong advisor or agent, then we can't comment much. But on the part of consumers, I would advise consumers, you need to do the due diligence. You need to read up a bit of investing at least and know what you're getting yourself into. I mean, regulation-wise, as advisors, we have a lot of restrictions and requirements in terms of this necessary disclosure, transparency. Yes, consumers do demand that from your advisors. Only when you get the right questions to the right answers, you'll get the right advice and you will benefit over the long run.
Definitely. All right, Eddie, your turn. The insurance agent or the investor? Who benefits the most?
The one that benefits the most is the insurance company. Next, insurance advisor. And lastly, consumers.
All right, some great, perspective from both of you. Thank you so much for joining me today.
Thank you.
Thank you.
Thank you. We've been speaking to Farhan Samsudin, who is a Deputy Director of Financial Advisory at Synergy Financial Advisors, and Eddy Cheong, CEO of Haven. Tune in again next week for another Hot Seat. I've been your host, Hongbin Jeong.
This is Money FM 89.3, Singapore's first and only business and personal finance station.